But this whole concept of deducting items that you dispose of during renovation also applies, by the way, if you're just doing, if you bought a fourplex somewhere for yourself, for as your own, investment, and you're renovating it, you should be identifying the items you're going to throw away, taking pictures of them, even if you're not doing a cost segregation study, take pictures of them, assign a value to them, and then write it off. I typically will tell and this is why I tell my clients all the time, I want to know whenever you're buying, selling, or renovating a property. And the reason I want to know these things is because when you're renovating a property, I want you to understand this concept of abandonment of assets, because I'm gonna tell you, look, as you're throwing things in the dumpster, have your contractor take pictures of, before and after pictures, so that you can identify everything that went in the dumpster and assign a cost to it. There's real dollars there in a lot of renovations that literally 90% of investors never actually take advantage of, because they just don't know about the strategy. Right? The last thing we'll talk a little bit. Well, we'll talk about two more things. The second to last one is repairs versus improvements. Repairs are deductible expenses in the year that you pay for them. Okay, so if I lay out money for a repair, it's a deductible expense in that year. An improvement is typically capitalized and depreciated over 27.5 years, right? So what ends up happening with a lot of companies, when you go, like I do a lot of syndicated entity tax returns, and I'll typically get these P&Ls from the management companies, and there'll always be this section on the bottom of the P&L that'll say capitalized items, right? And so these items are gonna end up being capitalized and depreciated typically over 27.5 years, right? When you actually go through the analysis, what happens with a lot of the management companies, right, is they're conservative. They put everything in a CapEx, right? They put a lot of stuff in the CapEx. And a lot of that stuff is actually repairs that should be deducted, right? Just as an example, whenever you turn over an apartment, okay, you go in there, you paint, you pull out one carpet and throw in another, or you take out vinyl and put in new vinyl. That stuff is repairs. That turnover is all repairs. All that cleaning, all that painting, all that stuff. There's nothing on that turnaround that should be capitalized. Okay. The items that should be capitalized are when you are actually making, when you're actually literally replacing big items, okay? And whenever you're using more expensive materials than you're replacing, okay? So if I go into an apartment complex and I take out, and I don't know why I would want to do this, but I'm using it as an example, I take out all of the laminate countertops and put granite in all of them, okay? Now I've got an improvement. Why? I use superior materials, right? So there are things that do qualify as improvements that are, that are capitalized items. But what you'll find is, and I do on my syndications, I do, detailed reviews of the CapEx items in the general ledger of the entity, and go through and I pull things out. Like painting is always a repair, right? All heating and cooling replacements are always a repair. Now, this isn't Ted Lanzaro talking. The IRS has a guide that literally says the following items are all repairs. I'm just reading off the list that the IRS, provide us, right? When you redo a parking lot, it's a repair, right? Okay. So there's also some thought processes on how to create repairs instead of improvements, right? So if if I'm going to do a roof, right, but I only need to do a portion of the roof, then that's a repair, right? Okay. If I literally pull the entire roof off to the point where I could look down into see the rooms, before I put the big roof back on, right? That would typically be an improvement. But the IRS says that a lot of roof replacements are actually repairs. So you need to look into when you're doing that stuff. That's why I tell people, when you're doing renovations, call me. Why? Because I get into the minutia. Most accountants don't. I get into the nitty-gritty because I'm looking to try to get maximum advantage of those things. So just know that exists. The last thing I think we'll talk about is what entity to use to take your acquisition fees. I see people doing this all the time. They'll set up an LLC and they'll say, "Oh, I'm going to take my acquisition fees in this LLC," right? When you're doing this syndication, you raise the capital, you're going to get your acquisition fee. Well, when you take an acquisition fee, that's actually self-employment income, right? So an acquisition fee is ordinary trade or business. You're in the trade or business of attracting capital to buy real estate, and that acquisition fee is ordinary earned trade or business income, right? So, according to the IRS, if you take it yourself in your own name, or if you have an LLC and you take it in the LLC, then those dollars are subject to self-employment tax. That's before federal income tax or state income tax, right? So the self-employment tax is the Social Security and Medicare that you would normally, like if you had a W-2 job, you normally have your Social Security and Medicare taken out of your check. What you may not know is your employer matches that amount before they send it to the IRS, right? So when you're self-employed, right, you're both employee and employer, so you get to send both sides, which is 15.3%. So if you get a $100,000 acquisition fee and you don't have any expenses to offset it, your self-employment tax is $15,300, right? Now, when you apply, then you apply your federal income tax and your state income tax. You could be, by the time you get done with all that, you could literally be at 40%, right? 25% federal, 15% self-employment tax, another 5% to the state. You might be at 45%, right? So you want to pay. And here's the thing, right? Medicare, if you're funding Medicare, for example, right, you don't get any better Medicare if you pay twice as much. Medicare is Medicare. You're going to get Medicare. Social Security makes a little bit of difference, but not as much as you would think, right? So you really don't want to be overfunding these programs, right? So you want to pay as little of that as you can. So by using an S corporation, what an S corporation allows you to do is income earned under an S corporation is not subject to self-employment tax as long as you take a reasonable salary. We typically set up reasonable salaries at about 50% of your net income. So on $100,000, we would make $100,000 net income. We would set your salary at about $50,000, right? And you would pay the 15.3% on that, but then you'd be able to take the rest of the money out of the company, not subject to self-employment tax, which means you save 50% of that tax, or about $7,650. That's a sizable difference, right? So what typically happens is people will say, well, I'm going to get, again, call your accountant if you're anticipating a big acquisition fee, call your accountant. How am I going to take this acquisition fee? I want to take it in LLC. I want to make that S corporation election, right? And then I get the money in, I can run one paycheck for whatever the whole salary is, pay that tax in and not worry about it. The other thing that it allows you to do, by the way, which you can do, which we do extensively, is assuming that you haven't taken any retirement plan contributions, say from a W-2 job or something, we can set up a 401k for that amount, and we can fund a 401k up to, if you're over 50 years old, it's 26,000 and change. If you're under 50, it's 20,000 and change, something like that. So we'll help you, we'll set up a 401k plan. And then you, in addition to that, you can make a contribution that's a percentage. You can do your elective deferral, which is your first 20,000, and then you can take a profit sharing contribution over and above that, right? So on $100,000 in an S corporation, you take a $50,000 salary, you can put at least $20,000 in a 401k of that 50, and then put another $10,000 to $12,000 in profit sharing in over and above that, right? Now, here's the other thing. I have some syndicators who have W-2 jobs, and they're like, Ted, I already contributed, maxed out my 401k at work. Okay, great. You can't make the elective deferral, but you can still set up a 401k for your acquisition fee S corporation and make the profit sharing contribution, right? So you still may be able to put away another, another 10, 12, $20,000. All depends on how much income you have in there, right? So that whenever you're going to get an acquisition, a good size acquisition fee, you want to talk to your accountant about two things. One, how am I going to structure it? Hopefully an S corporation. What is my reasonable salary going to be? And of that reasonable salary, how much of it, if I want to, can I put away for retirement? And what you'll find is that you can kill it on that typically. Right? So I'll tell you just some of the things. Landmark CPA Group, my firm, we offer strategic tax planning and investment consulting. I've been a real estate investor for 20 years. You'd be hard pressed to find something I haven't seen, been involved with, or done. We do all the typical business tax preparation, syndications, and real estate partnerships. We also do personal income tax preparation. My new partner, Bob, is now in charge of all personal income taxes. In addition to that, I run a commercial brokerage team. We source properties for our investor clients, most of which happens in Florida, because that's I'm licensed as a broker in the state of Florida and the state of Connecticut. We also have an arm that does commercial lending. So in certain circumstances, we can help with lending. Is that a question?
Well, we have quite a few questions here.
Shal, I think has his hand up. I think that's
yes.
So we can go to questions now. That's the next thing.
Yeah.
Questions. Okay, so let's answer some questions. I've got about 5 minutes, guys.
5 minutes. So yeah, thank you, Ted. Really appreciate your time and a lot of great nuggets. Let's see, maybe we could ask few questions. Who wants to speak about your question? Please.
Yes, Vinney, I had a question. This is Shal. I want to actually go back to the slide 11 where we were talking about the abandonment of the of the assets. So we have we are into hotel business. I think Vinney is my partner, and we actually in hotel we want to do improvements where the brand is asking us to basically change all the furniture of the common areas as well as of the rooms. Can we actually put them in that in this category?
Well, here's the thing. The furniture that you bought, if you're replacing the furniture, you bought the hotel, right? Mm-hmm. You may have already taken the depreciation on the furniture in year one when you bought it, right? So now the furniture has zero cost basis. So when you get rid of it, you're getting rid of something with zero cost basis.
Oh, wow.
So there's no benefit to that in years two. Now, if you bought a hotel in year one, right? And you literally threw away all the furniture that was in it, you would allocate part of the cost of that hotel to the furniture as part of the acquisition price. And then if you threw it all away, you would absolutely be able to take that deduction.
Understood. Okay, thank you.
All right. Who would like to ask another question? I know there were several. We'll just let you ask. Yeah.
is there a way that you could take part of the equity in the deal as opposed to an acquisition fee?
Yeah. Yeah.
Mhm.
Yeah, but you end up with what they call a carried interest, right? You know, because you because you never want to see the money. You just want to. So
Right.
if you don't take an acquisition fee and you just assign yourself a percentage of the partnership, you have a carried interest, and you want to hold that. There's some rules about that. You want to, in order to get the capital gains treatment, which is what you want. There's a hold time. I think it's 3 years.
Okay.
Oh, great.
Thank you.
Thank you. Somebody else? Any question? I know there were some questions in the chat. We don't have time to go through them. So please go ahead.
I guess I can go up with mine. It's very straightforward. So when we're doing syndications, right, and then there we talk. You, Ted, you brought up about cost segregation and how the benefit of cost segregation, and how you can offset with depreciation. But let's say you're buying. How does that benefit gets carried over to the investor of that syndication, because that's happening post you have done everything and you're offsetting the depreciation. You might be offsetting the depreciation from another property that you might have. So how does that all pan out in giving the benefit back to the investors of syndication A?
So if you're in a syndication, right, the depreciation is part of the net loss of the property, right? So let's just assume you had $1 million worth of depreciation and your net income for everything else is zero, right? Make it easy. So you've got $1 million of loss to allocate. So now it just gets allocated based on whatever the deal you cut is. Typically, it's going to be, you know, whatever percentage of dollars.
70-30.
Yeah, so let's say they do 70-30, you're going to allocate 70% to your limited partners. And then of that 70%, it just typically gets prorated based on the money that they put, based on the money percentage of the money they put in. So everybody gets their allocated percentage of that $1 million. So if I own a 1% interest, I get my $10,000 loss, right? Makes sense? So then the question becomes, me as the passive investor, can I deduct that $10,000, right? And most passive investors can't, right? Because they're passive investors, you're not allowed to offset losses from a syndication against their ordinary income, which is why at the beginning of the presentation, I was telling you that your best passive investors are going to be people who have real estate capital gains or real estate net rental income, because those people are going to be able to use it. So if I had a capital gain, I could use that $10,000 that I got allocated. If I've got net rental income, I can use that 10,000. Otherwise, it carries over on my tax return to future years when I have either real estate capital gains, rental income, or that syndication sells. And then I'm able to use all of the losses against whatever gain I get at the end.
Correct. And Ted, we could go as many years. Is there a limitation of accumulation, you know, of these losses?
Yeah, I mean, the capital, the passive loss carryovers do have a life. I've never seen anybody use the life up before they use the carryover. Not in the syndication business, because you're going to typically, because I think it's 20
7
years.
years maximum.
Sure, yeah, it might be 20 years, and typically you're out of the property in 5 to 7 years. So you're gonna use it well before the carryover ever expires.
Sure. Any other question? I know Ted does have to go, but anybody last question? Then we can let Ted go. Yeah.
I have a quick question, not directly related to real estate, but somewhat. So if we buy a vehicle for real estate business that's over 6,000 pounds in GVWR rating, I know that there was like section 179 allows only up to 25,000 in deduction, but I recently heard that you can still use the bonus depreciation to depreciate rest of the value. So you can technically depreciate 100% of the cost of the vehicle. Is that correct? Or
yeah, well, again, and here's the thing. So essentially that's correct, right? Now, that assumes, by the way, 100% business usage, right?
Right.
So, and that's the real trick, right? So, and also you want, so here's the thing. And I tell this to people all the time. And is, let's say you got a big let's say you got a big acquisition fee, right? And you're like, you know what, I'm going to offset that. I'm going to go out and I'm going to buy a Land Rover, right? And I'm going to offset, I'm going to pay, 100 grand for a Range Rover, and I'm going to wipe out $100,000 worth of acquisition fee, right? Well, you know what? If you can show the IRS that you literally are using the Range Rover 100% for business, and you have another car that you do everything else with, and this Range Rover is literally how you go to passive investor, you go meet with passive investors, and you run around to your active rentals and all, blah blah blah, right? It's 100% vehicle. Yeah, write it off, right? And if it's 90% or 80%, yeah, write off 80% of the total, right? You're still getting a substantial benefit. What you don't want to do is just go out and buy that car, and it's the same vehicle, you drag your kids around with, and you go grocery shopping, and it's the reality of it has all next to no business usage, right? Because if you do that, then the chances are that you may end up having a problem.
Yeah.
Sure. No,
Thank you, Ted.
good questions. Very good questions. Thank you, Ted. Thank you.
All right, guys. It
for
was
your
my
time.
pleasure.
Appreciate
Vinny,
that.
thank you for having me
God
on.
bless. You
See you
bet.
again.
Thank
Have a
you.
great day, guys. Be
Thank
well.
you.
Thank you so
Thank you.
much. All right, we'll come back here, guys. Let's see. I hope you got a lot of great nuggets, from Brother Ted, and he's just amazing. I know he's been on my podcast also, on my passive symposium, passive investor symposium last year. We got some, free footage on that one also. Lots of good questions were shared, asked in that one. And I would love to invite everybody, actually, because what we did was we did 2 days of seminar, 8 o'clock to 6 o'clock on Saturday and Sunday. And I think 1,092 people had registered for that, for a passive wealth symposium. And then we recorded it as I was chairing it. So we have that put into our Kajabi, platform of the Academy also. And we are giving free access for you to kind of go through them. It's got IRAs money, it's got EQRP, it's got insurance, it's got CPAs, it's got syndication attorneys. I mean, all my friends are there, and they spend 1.5 hours, with their presentations and question answers. So I thought I'll put a little plug, and we give it away free, in our Academy. So many of you are here, and many of you have joined the Academy. We really appreciate that. The other thing is we have a special going on. If anybody's thinking about joining or rejoin, is $497. Is that right, David? Right? You want to kind of go over that, brother? Yeah.
Yeah. So this weekly group coaching mastermind goes on, well, we'll say 50 weeks a year. There's always a couple of holidays that come up. So about 50 weeks a year. And it's part of Vinney offers this. Now he's offering it exclusively for $497, which is a $500 discount. So normally it'd be either $10,000 a year or $997 a month, but you can sign up and get it for $497. So a $500 discount a month, and then you get full access to all the information in the Academy, which includes the Passive Wealth Symposium and other things. And I'll drop a link in the chat if some of you are already in the, in group coaching or in, which is part of the mastermind, but some of you are part of the Syndication Academy. And so these mastermind calls will come to an end because you technically got 6, but Vinney wanted you to see Ted today. So I'll drop a link in the chat. And if you have questions, just send an email to info@vinneychopra.com. And we can always talk offline, if you have questions about. The reality is Vinney as a coach I'd highly recommend, if you want to learn how to get your first syndication, hire Vinney as a coach, but you may not have that amount of money. But in this group mastermind, this coaching program, you can still get all your questions answered and have all the advantages of having Vinney as your coach without the investment. I'm not telling you, look, if you're wanting to purchase your first or next apartment complex and you have the ability, hire Vinney as your coach. I mean, at least hire a coach. It'll keep you from making major mistakes. But if you don't have that, $497, think about it. If you paid that for 12 months, that's what, $6,000. You acquire a 20 unit complex and I mean, you could easily recover that on your first syndication in fees. And just from what you learned from Ted alone today, could more than offset that. So I'll drop that link in the chat here. I just need to go grab the link, Vinney, and I'll drop it in the chat. If anybody
I definitely want to say, like, my personal coaching students will be invited to the mastermind. Also, those who have already bought the course for the whole year, they'll be invited. So that will be there. But we'll be having a different login number each week starting from next week. So we just wanted to see, because I totally enjoyed, nothing wrong with it, but my main money is made from my buying and selling, and my academy is costing me a lot more money. To run the academy, I have to resort to that so that, we can have break even. I don't want to make any money, but I want to spread my knowledge, to lots and lots of people. So that's where I'm kind of going with it. And hopefully we'll have new people. I know a lot of people who learn the things, then they're gone, right? And which is great. And they're making deals and other things. And that's what we want them to do. But all the contracts we have signed, agreements, we'll go back and make sure that we deliver on those. If you had 30 sessions or 6 months in your contract, we want to make sure that you are invited. We'll have a special email go out to all of those, sure. All right. Any questions? But you know what? I'm here. I mean, we usually go for 1.5 hours. So we have 15 more minutes. Please ask any questions of me. I'm here for you. And we have recorded 3 years of this great, great material. I mean, 3 years or even 5 years. And we have so much stuff that we've not even edited it and put into the archives. My goal is to maybe hire more VAs to go through all these things over the last 4 years and snip out all these different things that I have instructed and gone and explained, so that we could put them into the archive. When I pass away, we could just give it free to everybody around the globe. So I'm kind of looking into it, some charities, so that it could be running on its own, so that we can be, making a platform like Khan Academy. It'll be Multifamily Chopra Academy or something, so that it can be presented, all over. Huh? I've got so many things in my mind. But anyway, please ask some questions. Huh? I'm right here.
So Vinney, if they want to continue education with you, is that an option that you offer also?
Yes. If you want to continue on, and that's, $497 is a pretty reasonable amount. We looked at a lot of things, usually it's a $500 off per month if anybody signs up in February. But after that, it'll be, $997.
Has it been 3 years already, Vinney?
Huh? What's
It's been 3 years already?
Yeah, I know.
It's gone by fast, huh?
Yeah.
Very quickly.
Yeah.
Yeah, no, but Vinney is a great coach. So what was it? When did I join? 2 years ago? 3 years ago? Was it 3 already?
I think so 2 years back, I think. And I'm so glad, it takes time. See, that's the thing. We can make a lot of mistakes. And a lot of times I find we have fear of failure, fear of rejection, fear of, am I going to step on this mines, to get blown up? So that's why I think mastermind, I think the only coach who really comes every week, and and I'm with you. Majority of the other programs, it's just somebody who did 100 units or 200 units, and they get to teach, talk to you, right? So I just kind of enjoy this, my 1.5 hour, and then personal coaching students I spend about hour and a half with them on a weekly basis also, but they are shooting off like into millions within few months. They are doing so high volumes, yeah. Harsha, you get a question? Yeah.
Yeah. Go. Quick question for you, Vinney.
Sure.
I know you're doing a lot of senior living
Yeah.
facilities across the country. You probably have 7 or 8 projects going on. I know you have GCs in and out, but how involved are you in terms of day-to-day progress of the projects?
I'm so glad you asked me that. The thing is, see, I partnered with somebody who is a specialist, a big specialist. He's done over 35 senior assisted livings in the last 9 years. So we have a cookie cutter, building plans and everything. We build the, structures, like replicas, literally replicas. And it's very easy for us to reduce the costs of all the materials and negotiate with the GCs. We have our own GCs and outside GCs, and then my partner oversees that side along with me. I'm on the loan, I'm on recourse loan. Majority of these constructions are recourse loan, by the way. 10 million, 20, 50, no, 10 to 12, 13 million loans, but we are looking at the progress every week, because our investors are given drone footages and other things and updates so that they see what we are progressing along. Like we built our senior assisted living in 9 months, from shovel in the ground, all done, ready to open in 9 months, 9 to 10 months,
Was that
And
Palm
my
Bay?
goal is pretty hefty goal, $2 billion. I always look for bigger things for this decade, to build. So we have 9 projects, going on, and we have 17 more projects on the works. So this is just in the, couple of years.
Now the land wise, in terms of the footprint, is how what's the typical size of the land that you use for these?
Usually 5 to 7 acres of land, 5 to 7, because we only build 1 story, Harsha, no elevators. And then we build 88 units to 93, 94 units. That's all. So we never want to go vertical. And we like the, passages and putting greens and waterfalls and swimming pools, all that, for giving the best of the best life. And we have, of course, the movie theater, spas, salons, dining halls, chandeliers, you name it, grand pianos. So it's a multifamily, giving the seniors the dignity of living and cook to order meals, restaurant style, the whole thing. So it's not making money. It's just giving them the experience of their lifetime towards their golden years, because they die after that. They go to hospice or they go to memory care, they lose, any recollection, everything. Or if they really get sick, they go to rehab centers. So this is the time, 3 to 6 years they spend in our facilities, and we want to spoil them and really, make them the best of the best experience, right?
And is there a dollar amount that you stay under for that land price to make sure?
Totally, yeah, $1 million. 5 to 7 acres for $1 million. Sometime I bought lands for 583,000. Also, I bought it in Palm Bay, Florida. I bought $783,000. I'm just buying another one near Orlando. I think it's 1.25 million. They wanted 1.8 million. We offered them less. They accepted it. So, when it comes to 2.5, 3 million, then the cost goes up, and the loans and everything. Then the starting point, which I can afford to give the seniors, also jumps up, and they can't afford it. So our everything included is $4,300 in Punta Gorda, in Cape Coral, best of the retirement communities, which includes everything except the cell phone in that price. Yeah.
Thank you. And last question, how do you, I know you have the best managers to manage these facilities. How do you select those people?
Good point. We have been doing it for my partner, of course, and I have been together 3 years now, but he's been doing for 10 years. And we are integrated vertically. So when we are 70% of the building is completed, being constructed, we hire the top-notch assisted living executive directors with 25 years of experience locally in that state. And then they hire their staff underneath them. So we have leasing people who really are total immersed in the community in assisted senior living. So we hire all the staff with the best of the best experience and their gumption and everything. And then we hire the chefs, and then activities director is a big one because ADLs, and then nurses are hired, and then our caregivers are hired. And we try to pay $1.50 more to the young caregivers so that they don't go away. They stay with us. We have our 88 size community. I have 50 employees, 50 team members. Majority of them are caregivers, 24 hours, then chef and assistant chef, and 5 people in the administration.
Thank you, Vinney. Thank you.
Thank you.
Hey, Vinney, this is Daryl.
Hi, Daryl.
How are you? This is a great presentation today.
Thank you.
Vinney, wanted to ask you a question about a compass and a map, coming into the academy.
Yes.
Where do we first start as neophytes like myself? And
Yes.
where's that compass and map that will guide me through stage 1, stage 2, stage 3, step 1, step 2?
Excellent.
Yeah.
We have like a 180-day, 6-month blueprint where we
Great.
providing you. We have put it, it's the same for everybody starting out. And then we have put together a course where it takes you drip system course. What that means is you're able to do the assignments and do it in a week. Then the next module opens up. Then you do that one next week and next week and next week, but you have full access to all the lectures and everything. But we just try to do it because everybody's got so little time, you know? So we have put together 8-week course, right, David? I mean, David is the brain behind it, and we are finding great success in that. Plus, you will also get other courses which have been there, which go into more details. So you can work on your own pace.
Yes.
The key thing is, I can see you on the backside. My team can see you on the backside. So you are recorded every time you log into the course. It tells me what you saw, what you watched, how long you were there. It tells me everything. So that's the beauty of the course, is that you are able to come on mastermind, but you got to follow through with the instructions to make it really happen for you, right?
Exactly.
Yeah,
exactly.
Surely.
Great. Thank you, Vin.
Thank you so much. Any other questions for me tonight? Yeah, please.
Yeah, Vinney, since we were talking about senior living and new construction, one of the things that me and a couple of my partners are trying to do this year is build to rent new construction.
Yes.
None of us have any background in construction, so we are trying to do a POC of maybe 12 to 16 units multifamily.
Yeah.
Using maybe modular or prefab type of construction method. Do you happen to have any, references, or because we are trying to bring on board an advisor who has that experience? So anybody in our academy, perhaps, who might be interested, or any names that come to your mind?
I can't think of here. I think, because most of our investors or academy students are try to get into purchasing multifamily more than building it, because building something has a lot more moving parts, huge parts. I'm recognizing it myself in the last 3 years. Lots of ups and downs and construction loans and overruns, 40% overruns in the cost of lumber and things and all that. So I would say I'm not the right person here. I do have not that many developers in my circle of even influence, by the way. Yeah, but maybe there are some courses. Are there, David? Do you know, brother? I know David is very astute entrepreneur, and he's bought and sold and rehabbed. A lot of us have done a lot of rehabs, right, David?
Yeah. So Jay, you can reach out, but Matt, who was on the phone before, who I do a podcast with for the last 3 years, Matt built for many years. So when you talk modular, it's a completely different animal, though, as opposed to just regular construction. So I would think you'd maybe want, I don't want to take up too much time, but I'll be happy to drop my name in the chat and see if I can put you with Matt. Matt's he's connected to a lot of people in and around the construction industry. So if we could help make a connection for you, that'd be great. I just dropped my name in the chat. Feel free to reach out to me and I'll get you in contact with Matt. So
that'd be amazing.
Thank you, David. Thanks,
Vinny. Thank you, Dave. Yeah, fabulous. I know we have a general contractor. I don't know if brother Daniel is here or is he gone? He's been also he's from Visalia in California, by the way. He joined my academy. Now he's doing syndications and buying things, but I know he's general contractor. I was just thinking about him, who else I can think of here? I don't think anybody else is a kind of like a general contractor, experience.
So Vinny, I did want to mention there was one question from Raj earlier that really didn't get answered is, what do you recommend is the best tax strategy for a W-2 employee investing in syndication? How can she or he maximize their tax benefits? And I know you could answer that question.
Totally. I would love to. See, the thing is, again, majority of the people are W-2 earners. Our, investors are, right? They are doctors, attorneys, they're teachers, they're, retired people even, right? So the key thing is, just like Ted covered, passive investing, you cannot mix passive income with your active income. But when we do the cost segregation and all these, and the losses come from the K1, you can accumulate it, right? So this way, minus 10,000 from 1 year can be accumulated, minus 10 again next year. Now we sell the property in 4th or 5th year. Now the gain is going to be high. You know why? Because we have to capture the depreciation. Oh my gosh. Like I just sold the property, my 150,000 investment, investor is going to get $225,000 gain, and they have to pay taxes on it. But by accumulating that negative will bat against the positive gain, and hopefully they won't have to pay any taxes, right? So that's how, Raj, the passive investors can also benefit. Like Ted also mentioned, whatever is negative in 1K1 can be batted against their rental income or profits of other passive incomes. So passive can be added, but active passive cannot be added. Only if you're a real estate professional. He covered very nicely. If the spouse can become real estate professional, then filing jointly, your whole situation changes to real estate professional. Even if you're a W-2 employee making $1 million, and then you have, the real estate professional, your active and passive income, gets together there. I'm not a CPA, but that's what we are finding. The other thing, my new thinking is, and I got interviewed 3 times today, is that I'm going with my investors who don't want cash flow because they're high earners, and they're saying, Vinny, don't give me cash flow every quarter or every month because my taxation is 50%. You give me 7.5, half of it is gone. In taxation, I make 3.5%. So give me everything in long-term capital gain, equity gain. So that's my new model that I'm perfecting it with my ultra-rich investors who don't need a cash flow. So that's a new model. I don't think anybody I've seen doing it, but that's what I'm doing now. My $1 million people will come in, 4 of them, and we'll start constructing my senior assisted living. In 2.5 or 3 years, I'll give them 54% gain. So their million becomes 1,540,000. How? And then if you take the gain of 540,000, 20% rather than 50%, their ordinary income, it'll be capital gain, long-term capital gain, or better yet, I can take that 1,540,000 to a new project with 1031, then they pay 0 taxation. But I'll give them cost segregation of 2 million. So almost half they will save in cost segregation, paper loss, I call it, plus they will be able to get 1031. So I'm just reinventing, from my logical mind, how I can serve my customers, my investors, 430 of them I have. And they are very rich people. They have played ball with me for the last 12 years, and so on. So, and also I'm attracting more ultra rich people, because I would like my one investor to pay for 4 million straight and then go into with me with the construction and get 54% returns on their money from me, and not pay any taxes. So that's something like that. I hope this was a good session, guys. Thank you so much. God bless you. And we'll see you next week. Please look for the new, ID, Zoom ID, because this ID will no longer be good after this meeting. So please do join. I think it'll be well worth it. I hope you can see the motivation behind it. You can, really respect that, you can bring the deals, you can analyze the deals, you can make, partnerships and everything in the mastermind. So it's a, small investment, which we are giving $500 off this whole month. So please sign up if you can. If you can't, that's okay too, but I hope you do well in your journey, to crush it. And, but we will be working with all the, students who have been already in the agreement in their, like Diego, then Ankur and everybody and others. There are a lot of them, so we'll be out. Daryl will be coming in, Carol will be coming, a lot of people. So, and maybe Amita is also in that phase right now that she's also included. I have to check on those, right? So David will go back and look at, when we got the investors going, right? Yeah. Thank you, guys. Thank you so much. And we'll talk to you again. Take care.
Thank you.
Thank you.
Bye.
Thanks.
Bye-bye.
Thanks.